Hi traders, what's going on? Lots of people getting ready to get in the show today. Usually you're not coming in dribs and drabs. I see the numbers ticking up, don't you worry about that, but everyone's queuing up to get in today. I don't know why, there's not a lot going on. I was going to say we'll call it quits for today and see you all tomorrow, but no, obviously there's stuff going on, lots going on, exciting stuff, lots of moves. I hope you're catching it. So let's get stuck into it. Lots to talk about today. Lots to talk about every day, isn't it? Good for us traders. Right, China. Banks are to gradually cut the mortgage rates on the back of the PBOC, giving them a shove, according to a paper out of China. These are usually, we'll call them state-sponsored, but you know, state-pushed, shall we say. So giving a hint of further easing to come from those guys. We have seen a little bit of a lift up in $1, which we'll have a look at. Finally, someone from the Bank of Japan showed up, decided to put in an appearance and give us a few comments. I've been speaking for the last week or so about how it's been radio silent from those guys, and we've had tweak expectations rising. Guess what? BOJ's Ueda said there's still some distance to sustainably achieve the 2% inflation target. The bank has been patiently maintaining easy policy. The BOJ narrative of on monetary policy won't change unless our assumption on the need to sustainably achieve the 2% target changes. So there's a later bit of context on that headline. It actually it was an answer to a direct question on whether the Bank of Japan are looking to tweak policy next week. So that comment there, all but shutting the door on a potential tweak next week. However, what does offer a chink of light is the line itself, which says the narrative on monetary policy won't change unless our assumptions change. Well, their assumptions could change at the next meeting. So that's where a chink of light comes in, because he's not going to give chapter and verse on their monetary policy decision a week before it's even happening. So a bit of a door close, but not a full door close. It's been enough to get tweakers running for the hills, as you can see there from the price action. There's been some good trading in dollar yen yesterday, a good bit of trading over the retail sales, which I'll speak about in a moment. But as you can see, Ueda coming out and talking at all has given dollar yen a bit of a leg up. We've finally broken through 139s and we're knocking on the door of 140 at the moment. So a bit of a change there, as I said. Doesn't mean that the Bank of Japan can't tweak next week. The door is open a chink, but him coming out finally, someone from the BOJ finally coming out, shows that they are keeping an eye on what's going on in expectations, and perhaps he wants to just keep a few feet on the ground. That's going to change the narrative for dollar yen for now, I think, at least in the short term. We couldn't crack any further in the downside. As I mentioned yesterday, any crack under 138, I was saying would, if this level down here was going to be solid, around the 137.20s, we would look to see support coming in around 50.60. We got down to what, 70, 68, 70. So that was close enough, as Dale would say, close enough for government work. That was helped a bit by Ueda as well, though. We came out just after we made those lows and gave the price a bolt higher. So the Bank of Japan leaving things a little bit settled or unsettled for next week. Ali, I'm talking, mate. Can everyone else hear me okay? Just give me a little nudge in the comments, please. Yeah, thanks, Dave. Ali, probably your settings again, mate. Right. Japanese bank, thanks Horatio. Japanese bank Mizuho says now that the Bank of Japan is unlikely to tweak its policy amid a forward guidance focus next week. So they're not getting into the tweak mode for those guys. Coming in over to some data, and you Kiwi traders might have been keeping an eye on this one. We had some CPI numbers out from those guys, a little bit hotter on the quarter, coming in at 1.1, hotter on the year 6%, both beating expectations. Quarter-on-quarter number did dip back, as did the year-on-year number. But there's some in the market who are taking this as meaning that the RBNZ could potentially lean a bit more hawkish at their next meeting. They're firmly in pause at the moment. Let's just check the rate odds. Yeah, only pricing a 17% chance of a 25 pip hike at their 16th August meeting. Unchanged is the favourite outcome from that. But a few in the market saying, as mentioned, that may get them talking a little bit hawkish because these numbers are quarterly rather than monthly. So that's what they react to. Just going to hop back to Japan quickly because there were some soft numbers from the Tankan report. This is a big manufacturers sentiment index. It came in at +3 versus 8 prior. That's the first decline in 6 months. Now, it is manufacturing. We know that manufacturing across the globe is not looking too rosy, so probably not too much of a surprise. But that is another data point that isn't looking too rosy in Japan. We're not talking collapses or any negative numbers, but just we were seeing a bit of a bounce in Japan's numbers. Now they're just easing back a tiny bit. Coming over to the ECB, and ECB officials apparently see communication as their toughest challenge at their rate meeting in July. And this is all about what guidance they give for whether rate hikes have got to their peak, whether they're going to do more, what inflation has done, so on and so forth. Inflation today, we've got the final numbers from the Eurozone. And a bit of surprise, uplift in the core number came in a pip higher in the revision, which puts it 2 pips higher than the May reading. So very much falling into the sticky category for the ECB. The headline CPI confirmed the drop from 6.1%, but it's all going to be about that core CPI number. That's what will be factored into their discussions, and apparently those communications are a challenge for them. Well, that's why they get paid the big bucks. So we'll wait to see what we have. You'll recall earlier this week we had ECBs not taking a less hawkish stance. One could consider it a bit of a dovish stance in terms of how many more rate hikes may happen. So we know we're pretty much nailed on for a July hike. That's done and dusted. The communication is around what's going to happen in September. Whether we get a clear message or not is going to be a bit decisive for the euro. Coming over to the UK, and big fun and games going on there. CPI has pulled back. Headline CPI dropping more than expected to 7.9% from the 8.2 expected, so a decent drop from last month's 8.7%. The core coming in lower as well, was expected to stay unchanged, so it's coming at 6.9%. 2 pips down. It's still very much in the sticky pot for me. I didn't think we would see a huge move there, or indeed in the CPI this month, but we saw a decent enough move in the headline number there. I think we've still got the case where we're going to see further falls in inflation kicking in next month, particularly mainly due to the energy price cap that came into effect at the beginning of this month. Won't be in those numbers, although I've seen some commentary blaming those numbers for this drop in CPI. I don't know how they can say that June inflation contains stuff that hasn't even happened yet, but that's me. So as far as the Bank of England is concerned, a bit of respite for them, finally seeing the numbers going the right way. That has again changed rate expectations. Literally 5 minutes after the data, we were still pricing a 58% chance of a 50 pip hike versus 42% chance of a 25. Then that has completely flipped around, and we're now pricing a 66% chance of a 25 and a 34% chance of a 50. So rate hike expectations coming down. Everyone running to the other side of the boat. Peak rate expectations have dropped like a stone. They're now under 6%. We were getting up to 6.5, 6.75 in some of those expectations. Now we've had a bit of an extreme move the other way. I'm just waiting on who's going to be the first bank to come out and write down their BOE peak forecasts. You'll remember that they all been hiking after the prior CPI report in May. They all hiked their rate expectations, as I said, to stupid levels for some of them, and now they're going to pay the price for that, I think. So bank forecasts, which you know my view of, aren't worth the paper they're written on, are all going to be coming down again. I don't care because I was positioned for it. I hope you were positioned for it because we've been speaking here long enough about these rate expectations getting to too extreme levels, and I wanted to fight that by selling the quid, and that I did, as you guys and girls know. So where are we from here? As far as the Bank of England is concerned, I think it probably does put a 25 on the table. They may go a 50 still, because that core number is still pretty sticky. But I think if they go a 50, it will be a pause 50, not a 50 with an indication to do more. They have been caught out with these numbers. As you know, they were doing 25s and then they had to jump to a 50. So I do think if they go a 50, that'll be them done for the summer at the very least, because then they'll get the next CPI report. And if it's another low one, that'll justify them holding rates where they are, because they are very reluctant hikers. If they do go a 25, it still might be a pause 25, but it'll be a 50-50 bet. They won't shut the door on another 25 after they've seen the next inflation report. The next meeting is August the 4th, August the 3rd, so they're not going to get another CPI data print in before then, hence why the next meeting could be 50-50 on whether they go a 25 or a 50, because they'll want to know what the next data is. So that's my view for the Bank of England initially. I don't think they're going to get higher. Still, my top end expectation for their rate is 5.75, but that's a bit of an outlier, 5.75. I think 5.25, 5.50 is probably a reasonable call for a top, in my honest opinion. Right, coming over or going back to the US data that we got yesterday as well, because some decent data out from there too. Retail sales holding up well enough. The data delivery these days, because in the US what they've done is no one gets data on embargo anymore. What happened in the old days, your news wires like MNI, Reuters, Bloomberg, they got this data under embargo, so they get it early, they can prep their stories. As soon as the clock ticks, they hit the button and all the data populates their calendars. The US has gone against that a couple of years ago now, I think, and now everyone has to scrape it off the website as and when it drops. So what happened was we got retail sales, the main number, coming in at a soft looking 0.2% versus 0.5% expected. That was the first number to drop. Then there was a few seconds as the other numbers dropped. Then the retail control group dropped. This is like the core sales, and it came in, as you can see, a big beat of 0.6%. So this is stripping out all the, you know, the high value stuff, autos, gas, that sort of thing. Was expected to drop minus 0.3, came in plus 0.6. So we saw the market dip on that initially on the 0.2 headline, and then we saw it bounce on the 0.6. Now, if you was on the Face Show yesterday, you would have seen us nailing that in the trading as it happened. As soon as I saw that 0.6, I was hammering the buy dollar button as fast as my fingers could tap. And so that gave us the change around. For the dollar, particularly dollar yen, it's added onto the Ueda thing as well. So it's been a bit of a double whammy for dollar yen, both from the data in the US showing soft landings, and then from Ueda knocking the yen side of things. So for the US consumer, still looking pretty good. No worries there. I've been saying I'm expecting perhaps there are some signs that there are some warning flags being waved in regards to the US consumer. I said I wasn't expecting to see it happening in this report, but I think it's something that is potentially coming over the weeks and months ahead. So I'm going to be keeping an eye on the news and the headlines, such as which we've been bringing to you this week regarding the consumer. But for now, soft landing numbers coming in from those guys, and no reason for the Fed to change its tack. Canada CPI, we did get a 2-print or a 2-handle in the headline number, 2.8%, so much softer than expected. 3% was expected, 3.4 prior. So this is another steep drop in inflation. I think this probably seals the deal for a pause from the Bank of Canada, though there's a lot of the market still thinking that we're going to get another hike from those guys. The pricing, the probability pricing, is showing that an 80% chance of leaving rates unchanged versus 20% chance of a 25 pip hike. So once again, we've seen a pull down in hike expectations. I thought they might have paused last month and they surprised with a hike, but I think this might push them firmly into a pause as well. The only thing that might not keep them in a pause is some of these core measures. Trimmed CPI came in at 3.7, beating expectations, not as big a drop from last month. The median, same thing, only dropped a pip, was expected to drop 3 pips. The other one they like to do, the common, again, only dropped a pip, was expected to drop 2 pips. So the core numbers, the same as everywhere else. As you can see, this is the BOC core as well, which did pull back a bit further, but some of the other measures still sticky. So that's probably the only thing I would say would keep them in the hiking game for now. But there's more data to see along the way from that. Industrial production in the US coming in not as, or coming in worse than expected, down 0.4%, was expected to rise 1.1%. That was year on year. In month on month, coming in the worst, minus 0.5%. Manufacturing down 0.3%. Both these were expected to come in flat, which was a bit of a surprise to me, considering what we've seen from the manufacturing PMIs in the US, all in negative territory, in contraction territory. So I think that was a bit optimistic, asking for a flat read there. Capacity utilization coming down as well. That's the amount of, how should we say it? The amount of capacities that factories operate at. You want to see a nice high number to show that there's a lot of activity. If that comes down, it's a sign that activity is lower. Again, reflective of what we've seen in the PMIs of late. So again, we've got different sectors going at different speeds. The consumer side of things looking okay. Manufacturing is still looking poor. We get the next round of PMIs, I think, kicking off next week. We get the Philly Fed tomorrow. The Empire on Monday was a positive number. So let's see if there's maybe a little bit of a bounce in manufacturing from those points, those data points, and then we'll see whether they're dead cat bounces or not. As for the Fed and rate expectations, we are now 96% probability of a 25 pip hike versus 4% unchanged. We have had further drawdowns in expectations for the second hike that was meant to come, and expectations are increasing for cuts in 2024. So we've got a little bit of a shift going on in that side of things. One other bit of data was the LHB Housing Market Index had been showing a good improvement, came in unchanged at 56. So a bit of a pause there for that number, but we're still recovering in the housing market. Over to earnings, and more banks and financials were out yesterday, all pretty much beating expectations. No problems there, solid numbers coming through. That's keeping obviously stocks well supported because there's no problems from the banks there. Still lots of earnings to come under the bridge, different parts of the economy, so we'll watch those carefully. Again, I'm going to be watching the consumer points, companies like Target, Walmart, Amazon's, that sort of thing, just to see if there are any problems bubbling underneath the surface. That's it from the headlines, so on and so forth. So let's get stuck into the prices. Horatio holds short the pound till the August meeting. Yeah, I'm going to keep my shorts in euro sterling. So I don't know, why don't we start there? So euro sterling. So as you know, I was looking at this, been looking at this 85 area for a trade way back when, even before we got the move down there. I got in longs here, got a decent recovery just on some of those rate expectations coming down. The CPI has obviously given that a huge boost. So I'm happy to sit in these now, and I'm going to look to build on my position. I think there's still probably a bit of way to go for repricing the Bank of England. The market is still around the 6% mark for a peak rate for the BOE. I think that's still a bit toppy. So I still see room for the pound to correct on those expectations. But for euro sterling, a lot is going to hinge on next week's ECB as well. If there's any indication of a top being put in at rates on the next hike, we could see euro in general finding a top in its moves in itself and then coming back lower. If the ECB are indicating a pause, let's say they go with 25, that would leave them at 3.75%, with the Bank of England effectively heading to 5, potentially 5.5%. So there's still a bit of rate divergence that may be in the mix for euro sterling. That would mean a pullback probably in euro sterling. Again, that may just be a dip by an opportunity because the other side of the rate hike cycle is when are they going to start cutting. And I would expect that the Bank of England may be one of the front runners to start cutting, because their pace of hikes and the height of interest rates are probably going to bite a bit more than we may see in the Eurozone. But it's not going to be a clean trade. It's all going to be on watching the data dependency. Who's going to be the cleanest shirt in the laundry basket? And that's going to define which central bank's going to be cutting first. But I think the higher the UK have gone, the harder the fall is going to be, and the ECB may limit that damage because their rates aren't as high. If they peak at 3.75, you know, that's not going to be a huge negative for the economy, different to the Fed BOE being up in the 5%. So anyway, that's my thinking for the future for this trade. I'm happy to be long. I want to be building it. I'm so gutted it wasn't a hot number today, because I would have loved to have steamed into more longs in the euro sterling, more shorts in the pound, but it was not to be. So as often is the case with trading, I'm not in as big a position as I would have liked to have been, but I'm not going to complain. I'm well on side. I've got some margin in it now. I can run that into the ECB, and it gives me some room to see what happens next. Now, technically, we do have my big old level up here, 87, call it 1520. I've got a line in there that's just been sitting in there for a while. It's been a real big resistance point since we had the breakdown from the 90s, as you can see there. So the big fat line, you can see there, all the resistance sitting in there as we had the breakdown. You know, we're talking days here, pretty much a month where we couldn't get through that number, hence why we carry on moving down. But as you can see, it's a big long historical area as well. this 87.20 zone. So this is my big number. This is where I want to see it above. If I can get that before the ECB, then I'll be very happy with that. Because if we get above there, hold above there, then this is every chance of moving up towards maybe even the 90s again. But I'll take each step of it as it comes. There's plenty of techs in the way. We've got fibs in the way. As you can see, we're just knocking on this fib now, 86.85, which is actually the high of the day. So, you know, we're putting this trend to the test, but it's got some work to do. I want to be above 87 to really feel a bit more comfortable in this trade. So let's see what happens with that one. But I'm happy to stay short and keep that running for as long as possible. See how long I can hold on to that horse. Dollar yen, as mentioned, we've got, let's get the right chart up first. Here we go. So 140 is the next boundary here. Let's just come in a bit because that trend line is looking a bit wonky on that time frame. So coming in a bit shorter, it's done. Technically, it's done what it needs to do. You know, we've been trying to bust through this 139, and I had half of mine that if I went to bed last night, I'd wake up and we'd be through 139. I was thinking maybe we get some other BOJ bods out, but that wasn't to be. But the soft data has helped it as well. But it's doing what it needs to do. It's now holding above this zone, holding above this 139 and above this fib. So it's broken and now it's finding support. So technically, that's exactly what you want to see from a break. You want to see the broken level holding, and it's done so over several hours, and we're kicking on higher. We did have this short-term trend line in, which we held below for a while. We've now broken it. Again, looking at the short term, I want to see this becoming support. There's some indications it might be. I want to see a proper test of it and a proper hold. If we get that, keeps the momentum going for buyers here. Now, as I said yesterday, during face or after the Ueda comments, what Ueda has done is now he's put some doubt into the mind of sellers. So all those who were thinking that the Bank of Japan were going to tweak are now having to reassess their thinking. The break of 139 has accelerated. This is where the sellers were all parked up and happy to hit rallies, but now they've got something to think about. Does it mean we're going all the way back to 142? I don't know. I think we're probably going to get a bit more upside in this, at least in the short term, just as more of those tweakers throw in the towel. But, you know, if you get the next round of decent data from the US, it could all change. But I think now we've flipped from rally selling to dip buying. So the light switch has changed. So I think if you're looking at this one, whereas everyone was trying to catch a knife on the way down here, now everyone is going to try and be picking tops on the way back up. I think you want to be looking more at the dip buys. You don't have to put a lot of money on the table, pick your levels. You know, if you want to trade off this trend line, go ahead. But, you know, 10, 15 pips below, the trade's likely wrong. So you don't need to risk a lot trying to go with the trend. If you want to fight it, again, you know, pick your spots. If you want to trade into 140, go right ahead. But, you know, 140, 15, 20, the trade is probably wrong. So you don't need to give it a lot. You don't need to be losing 2-3% on trades like this. Not even 1% risk you want to be putting on trades like this if you want to fight it. But yeah, I think the sellers are now the weaker hand. So I wouldn't be surprised if we do get a push up. But the market isn't likely to go too far because, again, we've got the Bank of Japan next week. We've got the Fed next week. So a lot can change. Where I think you might want to look around for your fixes for yen trades is other pairs. Guppy, for example, it's between a bit of a rock and a hard place at the moment because obviously we've had that softer CPI data putting pressure on the quid, yet we've got the Ueda stuff putting pressure on the yen. So this one looks to be a bit stuck in the middle at the moment. You compare that to the euro yen, which is really taking off a bit. This has got a bit of a double bubble. It's got the yen side and it's got that sticky inflation side kicking in. So I think the market is looking at that core CPI today and thinking, yeah, that's sticky enough for the ECB to remain hawkish. So it's a bit of a tale of two cities between the two. I think if you wanted a quick Bank of Japan trade, if we get this down, guppy down to this low here, down to the fib again, on further pound weakness, I think that might be a potentially good quick trade for the Bank of Japan if they don't tweak, if they remain unchanged. We'll probably get a decent rally in that as we move from one central bank to the other. What it does after that is open to question. I think if you manage to get something in here, if the trade worked, you got a long in here, you got a Bank of Japan unchanged move up to 182. I think that's a sort of area you might want to think about getting out. That'll be a nice 260 pips odd, and that's nothing to be sniffed at. So what I like to do is when I'm trading between the central banks, see where each one leaves a price. So at the moment, I think this one's a bit in limbo, but if we get a move down on the pound side, I think that might be a good fade for the Bank of Japan. Euro yen, it looks a bit different. What you want to see is going into the Bank of Japan, doesn't unchanged, take out that high. If we get an unchanged number and it doesn't take out that high, that's of course if we haven't broken that high already, then that gives you a bit of conviction to say, right, well, this one's putting up a solid fight up here. That's potentially where you're going to try and fade that particular move. So it's all about looking at matching off the countries, matching off the central banks against each other, knowing what one is doing versus another. We can have a look at Aussie yen. Looks a bit similar to guppy. We've had the move up, we've had a move down. It's just hovering around in there. Hasn't had much of a upside move on Ueda because, as we know, the Aussie dollar is looking a bit weaker again. So it's the pull and push between the two different currencies. That's finding resistance once again up around this zone. We've had this move up here last week up to close to the 69s. That's pretty solid now. It is looking like a decent double top. 67 is going to be your level below here. We do have some smaller lines, 67.40, which is a bit of an on-off support and resistance zone as the price moved around. But 67 is the main support level for me down below. So again, if you're trading the yen, keep an eye on what Aussie dollar's doing in this one. Let's have a look at some of your questions. Pivot zone, that back to 2016 a week ago. Was he talking about that euro sterling, Gav? That 87 level? Yeah, it's a. I think that's the one you're talking about. It is a big old. Yeah, you can see. Look at that, all the way back 2016. I think it goes back even further. It's a bit messier back here, but as you can see there, 2016. That 87.20 handle, one of those big numbers. These are sort of numbers you always have on your charts. You never take them off because historically they happen time and time again. And that's a bit like the level I've been pointing out in euro dollar, the 115. It's a bit like your 87 in euro sterling, a big old level. So this remains my key level for euro dollar. It feels like we're running out of puff a bit up here now. We obviously had that move up to near 1280. It's been down since. It's not given up too much. We had a little nick under the 112, only by a handful of pips, not enough to call it a break. That was my support level down here. But, a bounce to 40, you can see the price action that's been going on all through most of July. I'm not expecting that to change at all, really. Obviously, we have more data to come, the Fed, the ECB, and whatever. So that's likely to make a move. But again, this one for the ECB, if we don't get a move up, we could get a move higher on the back of the Fed, indicating they're one and done. But after that, if the ECB indicate that they're one and done, I expect to find a bit of a top. Now, what I'm not looking forward to, particularly with this one, is after next week, we're going to be really hitting the summer trading, and likely this one is going to die a death. And hopefully not. Hopefully I'm giving it the kiss of death. But I'm not looking forward to potentially seeing this one trading 20 pips a day all through the summer. What I would be careful of next week, just a bit of forward guidance, as central banks like to call it. We've done a lot in a lot of pairs, particularly the dollar. Cable the same, euro the same. We've had some quite hefty moves. I would not be surprised if we saw a bit of profit taking after all the central banks next week, as money comes off the table for the summer. There was a point I was making in the chat room yesterday. If you take US yields, you take like a 3-month bond in the US, you can earn 5.4%. So what do you want to do for the summer if you want to take a bit of risk off the table? You're going to leave it in FX, where it might move, something might happen, or you're going to stick it in a 3-month bond and 5.4% while your feet up on the beach. So I'm expecting potentially some moves out of FX, some moves out of other assets, and potentially some moves into bonds. I wouldn't be surprised if we see bonds going a bit bid at the end of next week, just as people position for the summer. That being said, summer trading isn't as big a thing as it was. A lot more people at desks these days. Before you'd have, if you had 10-man desks, you might have 2 or 3 people in over the summer. Just to manage things. But now markets are different. There's always something going on. So there's always the machines, at least, are still on hand, and there's still plenty of people in the offices. So it's a bit like summer driving season in the US. It's not the thing it used to be. It's now more a year thing. So, we've had crises going on. We're still going to have a war going on in Ukraine, probably. So there's still going to be plenty of stuff going on in geopolitics and the like. But barring any big news, we are going to see a drop off in liquidity next week, and that's not going to be good. Well, at least we can all go down the beach. Still can come back from the beach and do some work. Anyway, quick look at cable. Again, what I really want to highlight from this is, we've had a big move off the top. We've had a big move today. Look at it in terms of the context of the trend. Are we even close to turning this around? No, it's a big move. It could continue. But if we're going to start reversing this trend, we've got to break some big levels. The big level is down 128.50 and this 38.2 fib 128.24. Further context, this is only the second part or the latest part of the bigger trend from last year. So I'm not even bothering putting a fib in there because, as I say, that the first part of that fib probably doesn't come in until about 121 or somewhere. So for the longer term trend, we're still well in it. No reason to change it. But the shorter term, this level up here is going to solidify as a resistance point. We're bouncing very weakly at the moment. The next level for me is going to be around 129 before we hit that big level down at 128.5, 128.24. I'm going to be expecting 130, 130.15 now to be the main resistance area. If we get a move back up there, this is where I expect us to find resistance coming in. We've got a little bit of resistance building around the 60s. You could draw it off these two highs and lows here. But I want further evidence of that to see that building there before I trust it. Till then, 130, 130.15 is the main resistance point for me on that. Let's have a look what else you got going on. Ali says everyone is watching the dollar size. What about the euro fundamentals, so on and so forth? Well, as I've just explained in the euro, what I think about that. It's all about the data. It's all about what the ECB deliver next week. If they keep September hike on the table, then I think that's maybe a last hurrah for the euro dollar. It's really all these pairs, all these currencies, it's about, we're trading peakness now. We're trading peak rates. You know, this you could call when the market got peaked over Fed rates, because it's been nothing but downhill from that 145 level for dollar yen. You know, euro, we're running into trouble up here. Cable, this is probably peakness now after we've had that CPI number. So this is, a lot of this is all rising bank BOE expectations. You know, the same for euro sterling. The move down we got all through May. So it really started, where am I going? It really started here back in May. This was all pretty much Bank of England expectations driving this lower. Got a few bounces on the data, on the ECB and whatnot. Still, we were pricing the Bank of England. This is when it was getting really excessive, hence why I wanted to scratch that itch and short the quid. So we're at peak mode now in markets, and the data is going to tell us, or tell the market, are they right to say we're at a top in rates? And if we're at a top in rates, well, the next direction for a lot of people is down, and that's going to be the game we're going to play for the rest of the year. Hence why us and everyone else is data dependent. Okay, Ali, let's have a quick look at the old gold. So a bit of a break on here. Finally resolved this 60 area. Even managed to get up to that to near that 1985-86 zone as well. I was moaning yesterday that this was looking a bit grindy. We weren't dipping that far, but we weren't really looking like we wanted to make a new high. Well, we've had a little bit of a blowout. We cleared some of these previous highs, and now maybe we're holding them as resistance. As support. So technically, it's doing what you would want it to do. Sorry, let's go into. Let's see. So some of these highs up here, I was looking at, not for anything to say this is where the move's going to stop, but this is where you might get a bit of traffic. And as you can see in there, we did get a bit of traffic, but we're holding the tops of those highs now. So what do you want to do? If you think it's going to 2000, is it ready for 2000 break? You know, it could well be, but if it's going to break 2000, first it's got to get through 1986. If it can't go through 1986, 1985, 1986, it's not going to 2000. So if you weren't in on any part of this, it's a bit difficult to buy it here. Maybe if you've got a retest down to the 60s and it holds, that might give you a bit of a springboard to get into longs if you missed it, and maybe get a run up to the 2000s. You obviously wanted to have been trading that break, but we can't trade backwards. So if you're looking for, if you're in it, good, you've got some support. Technically, it's doing what it should do. If you start breaking back under some of these levels, then maybe it's not going to get to your 2000s. But while it technically holds and finds support on the moves higher, gives you every chance of getting a run to 2000. That's obviously going to be a big psychological level once again. So wouldn't be surprised to see resistance coming in around 95s, somewhere like that. Do you think silver can get to 40, like some of the calls have been saying? Can it get to 40? Well, let's have a look. Right, well, we're going back to 2000 and it just about got to 30. So can it get to 40? Of course it can. Does it have a chance of getting to 40? It depends on the driver. I mean, we've been struggling around these 20s to 30s for a few years now. So it's going to take something big to change it. Now, if you look at it from the industrial point of view, in terms of it being a commodity used in various products, the market or the environment at the moment, the fundamentals say that manufacturing is very weak, China's very weak. So fundamentally, I see no reason why this should even go to 26, let alone 40. because the demand potentially just isn't there. The activity just isn't there to warrant a move higher. If we see economies picking up, if we see manufacturing picking up, if we see China picking up, that's going to be a driver for a higher move in silver. But fundamentally, this, as well as plenty of other commodities, I see no reasons on the demand front why this should go higher. We can also look at that from the standpoint of something like oil. You know, there's been some headlines floating around that the demand supply gap has been closing. So now we're getting into a deficit where supply is less than demand. Now that is obviously supportive of prices, but as usual, you need some context behind it. That deficit is okay when you've got strong demand rather than lower supply, because if you're producing 10 million barrels per day and countries are using 20 million barrels per day, then obviously you've got a bit of a deficit going on. Now, if that ratio is now 1 million barrels being produced a day and 2 million barrels being used, you've got the same deficit, but your activity is much lower. Instead of using 20 million barrels a day, you're only using 2 million barrels a day. And I think that's the environment we're in at the moment. So while some in the market are saying, oh yeah, prices are going to be supportive because the supply demand is in a deficit, activity is far lower. And that's not good for prices overall. It doesn't mean prices are going to rocket up to $100 on that scenario, because you want a deficit where there's a lot of activity. Same as how I look at GDP numbers. I look at the imports and exports, because it can, or trade balance data rather, because you can show a decent trade balance, but if you've got negative, if you've got plus 1% imports and plus 1% exports, that shows plus activity. You can have a better trade balance, but both are negative numbers, and overall that shows that there's negative activity in the economy. So the same thing for oil, same thing for the supply and demand in things like silver. It's all about how much is being used, not whether it's in a deficit or a surplus. So back to silver, and I know Still will be back next week, and maybe K-Man as well. So I know they'll dig into silver and let you know what they're thinking about that. But for now, it's trading the levels. You know what you need to do. 24.5 is your support area. We are trying to get above 25 and hold it. So if you get a significant hold above 25, then you're really probably going to get a push on. A bit like gold, you know, it's looking a bit huffy and puffy here. So you need a nice decent break of 25, a nice retest and hold, then you're probably looking at higher up. But as for 40, no idea, don't think so. Not on, not today anyway. Gavin wants to look at pound Aussie. Let's grab that. I know it's in here somewhere. There we go, just above the gold. 92.30-ish, looking like a bit of a level. Let's have a look. So just coming up around here. Yeah, I was looking at this morning as well. Yeah, I can see a level there. We can chuck a, give or take a few pips. I can see what you're talking about there. I was looking at this one a bit higher, 92.70s, but I'm not going to argue with you over 30 odd pips, 40 odd pips. Again, I think this is in a similar vein to Guppy at the moment. We obviously a down move in the pound, but we know Aussie is weak as well. So this does have a chance of moving up. I think this is probably decent enough for a range play. If you get a move down to support here, you might start here at this bottom. If you're looking from the long side down into the low 90s, otherwise definitely into that level there. Bust below that, I think if we clear 89.40, then something else is happening, and we're heading much lower on that one. Daily shows it well. Let's have a look. Oh, so it does. There you go. Moving across to there. Good eyes, mate. Good techers. Good to see it. So yeah, let me know what you're looking at. You're looking at resistance. You're looking at shorting up there, or is that where you're going to be looking to exit longs if you've got them on the books? Let us know, Gav. While we wait for that, quick look at yields. We're getting down to this 3.7 level again. It's really marking a bit of a range that we've been in. This trouble area that we had here. 3.6 is probably the line in the sand, you know, maybe down to 3.5859. But this 3.7 was where we were at before the CPI, the data, and everything like that. We're edging down there now. I wouldn't expect this to break unless we see any collapsing in the data, particularly ahead of the Fed next week. But you can see some of these shorter end the moves, a bit more pronounced off the highs, but the market's still settling in just above this zone here, above the 4.6s on the 2-year yields. So this was our rule of thumb for trading where we expected rates to go back, and it was a bit of a zone, bit of a trading zone going back, and we're just sitting on the top of that for now. But central bank's going to be the big driver for that next week, and whether we've seen a top in yields as well. Right, have you boys and girls got anything else you want to talk about before we head off? Quick look at stocks. Keeping their gains, you know, still no reason to fight the trend. If you want to scalp off the top levels, you know, please do so, but know the wind you're pissing into and manage that risk wise. 46, 45.90, 46 is the next level above. Every indication that we're going to be going there. The earnings still coming out strongly. No changes there. We start to get a few of the other sectors, as I mentioned, coming in. So keep an eye on the other indices as well. Dow, obviously, still printing highs. NASDAQ as well, still going and going. So maybe the NAS is on for a move up to these big highs up here, up in the 1647s, 70s, whatever you want to call it. The big all-time high up here. No reason to change this unless we start seeing the data really significantly pull back. Stocks are going to keep going. And for me, I don't know where the top is going to come. It's not something I'm going to guess. But if you want to trade it, if you want to try and pick the tops, pick your levels, pick your battlegrounds. 46 is one, 46.30 is another, and then we start getting back into the range of the all-time highs. But in this one, I think dip buying is the side you want to be on the moment. Gordon says pissing into the wind is the counterpart to knife catching. Yeah, well, you can piss into the wind on both sides. It's pretty much when you're going against the grain, when you're going against the trend. We had a saying, can't remember what saying is for picking tops. I know if you're picking bottoms, you get smelly fingers. That's the saying we used to use on the floor. Pick bottoms, get smelly fingers, as well as the catching knives, lose fingers. I can't remember what the one is on the top side. But anyway, it's the same both ways. If you've got a trend and you want to fight it, just be careful how you do it. Ali says, if we make a risk-free trade, then we have to take 3 times more risk on a single trade as a normal trade. If you make a trade risk-free, not sure what you mean by that, mate. There's no such thing as a risk-free trade. You can get your trade risk-free as quick as possible, which is what I like to do when I trade. I'm not interested in profit when I put a trade on. All I'm interested in is getting my risk down to zero as quick as possible. So I'm not quite sure if when you take a position, it goes into your direction, you make it risk-free. Yeah, that's right. But you don't need to take 3 times more risk on that. That's the part I'm not understanding in that one, Ali. But maybe put something together and you can hit me up with it tomorrow. Just looking at the data front quickly today, we've got the NBA data coming up in just over half an hour. Just keep an eye on the mortgage rate for that, the effective mortgage rate for that. It has been stepping up quite significantly, 7.07% last week. I think it was up from 6.85 the week before. So that rate getting higher may start to put a bit of pressure on the US housing situation, although it's not the same for the mortgages over there as it is for other countries like the UK. Building permits and housing starts out as well. Are we going to get more soft landing numbers with positive numbers there? That will all feed into the pot. Keep the Fed on hiking street. Probably will add to dollar yen rallying. The last couple of weeks, the dollar's been hit pretty much after every strong data point. Now that might have changed. So we might see the dollar rallying and it being sustained. So just watch out. When you get these changes in markets moves, you got to know when to switch with it. So what was working last week, what was working yesterday may not work today. I think we've had a bit of a light switch moment. That's it for me, folks. Stay safe, trade well. Do check us out in the chat room if you haven't already. Horatio, thank you for your kind words. Yes, these webinars are free. If they're that amazing, I can always charge you for them, but be careful what you wish for. You may not have known us about before, but you certainly know about us now. So spread the word. You know, you can come and join us in the community. You know how to find us. If you think we do a lot on these webinars, wait till you see what we do in the chat room. Anyway, that's it for me. Have a great day. We'll see what the rest of the day brings, and we'll see you all tomorrow. Thank you very much, folks.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.